Well, welcome back to Finance Uncut. On today's episode, we're going to have a look at the gold and silver mining and exploration space and what are some key metrics to look at before investing your hard-earned capital into these stocks. And we're going to revisit my stock scorecard from 2020. We've touched on the benefits and uses of silver in previous videos, so I'm not going to harp on about it. You all know that the demand for silver from an industrial sense is very strong, and moving forward as we move to a green economy and electrify the economy, that the demand for silver is just going to continue to go up from here. While at the same time, we know that that silver production or silver supply peaked in 2016. So whether it's mining production or the secondary market with silver that gets recycled, that's peaked, and from all reports, that silver extraction goes down from here on in. Now we've also seen the US private investment in mining exploration fall to its lowest levels in history. So that's where we're at. There is a tick up from that bottom. So there's starting to become more exploration companies and investment into this space. But it's never been this low before. When you get the group break-even weighted average break-even cost for all the top miners, silver miners that is, we come with a break-even weighted average of $16.54 an ounce for silver. So if silver's around $27, then what we get is a lot of free cash flow. And that's exactly what we're seeing in the charts. Gold and silver miners, you can see that the free cash flow has never been higher, while at the same time, gold and silver miners' balance sheets have never been this good. Silver is cheap on every metric, whether it's a silver to currency supply ratio, the commodity index, the commodities to equities ratio. I've shared these charts with you all before. Gold and silver for me is really never been cheaper, and commodities in general. And I think, as you know, I've explained, we're likely to be moving into a significant inflationary environment in the years and maybe even decades ahead, according to some. It's probably a great time to get into the commodity space and the precious metal space. And the median total debt to assets ratio for gold and silver miners is the best. It's the best out there. So from a risk reward point of view, I think being in this space is fantastic. For me anyway. For you, perhaps not. So looking at my stock scorecard from 2020. Now, I'm not saying what the different stocks that I own are. I don't give financial advice on this channel. I'm not allowed to give financial advice. And you know what, even if I could, I still don't know if that would be appropriate. Because there's a couple of these positions that I've since sold out of. So the third one down there where I made over almost 2,500%, I don't hold that position anymore. I've taken profits off that. I can tell you what company that was. It was Chalice Minerals, ticker code CHN from memory. So you can go have a look at that. I bought that back in March and sold it towards the end of the year. I believe the stock price, the last I saw it, was around $4.50. So, hey, you might think I sold out early, but anyway, I've reinvested that capital into other projects. So I don't want to, I don't want to influence people to buy a certain stock simply because I've got it. You know, there's a lot of people out there that do the pump and dump, and so I guess I just want to, I'm happy to share the stock names after I sold them and gone. But yeah, not beforehand. But a lot of these, basically what I want to say is a lot of these positions here and here is is in that gold and silver exploration space and mining space. So there's a few biotech positions in there as well, but predominantly in that gold, silver mining space, and a couple in other commodities such as nickel and zinc in particular, and copper. So definitely had some very good returns in 2020 in that precious metals and commodity space. Now, yes, down the bottom, put options in March. So we did buy put options on some individual stocks such as what did we do? We did Qantas, we did Flight Centre, we did Harvey Norman at the time. What else was there? There's a couple of others. I think, did we do QBE? QBE. I know there was another one. Anyway, we bought put options on some individual stocks, and frankly, our return there, which was in about 2.5 weeks, of 780%, we could have actually done a lot better. I was going to short in the final, or buy put options in the final week of February. I waited. I went up to Mount Tamborine on the weekend, the first weekend, or the last weekend of February, first weekend of March, and I was just thinking about shorting. Need to buy put options. And then Monday morning, as the market was falling, my trading CMC was playing up, and so I didn't end up buying those put options until about an hour and a half after it opened, and the premiums on those put options had already gone up significantly, by that morning, and more than, I think, just over doubled from the Friday beforehand. So being a little bit late to the party, I definitely left some profits on the table there. But that was great returns. So, but this video is on gold and silver miners and explorers. So I've talked about this in a previous video as well, that the silver miners versus silver generally outperforms. If you buy the right silver miners, they generally outperform the silver price, which you can see here. So you get that exponential leverage. So a lot of people ask me, you in Bitcoin, you're buying Bitcoin, it's skyrocketed, no. And when they say, well, gold and silver's boring, it moves slowly, blah, blah, blah. Yes, I own a lot of physical gold and silver. I think that's very important to have a portion of your portfolio in the physical metal. But for me, I like to get that leverage. And where I've had success in the past is in the gold and silver mining, and in particular the explorer space. The explorers is where you get the real big leverage. But there's a lot more risk in the explorer space. In a bull market, if you're bullish the underlying asset, in this case silver and gold, then the miners will do well. And it goes the same way when gold and silver go down. These generally the gold and silver miners and explorers go down a lot quicker as well. So you've got that leverage play on that, and you'll see an example shortly of how powerful it can be. So this is the 08 to 2011 bull market in silver. Once again, it's those silver miners that do outperform the underlying price of silver. And the same thing with gold. So, once again, if you buy the right gold companies, then you'll outperform the underlying asset. And so once again, I think it's wise, well, for me anyway, to have a portion of your portfolio in the physical metals, have a portion of your portfolio in the mining space, and a portion of your portfolio in the exploration space. So the charts really speak for themselves when you're looking at the big miners, that the miners do outperform gold in a bull market. All right, so here, Saracen Minerals, now they have just merged with Northern Star. As of a couple of weeks ago, they have been delisted. However, if you bought Saracen, in June 2013, they were trading at 8 cents. So they're a small exploration company. It last traded at $4.89, I believe, before it was delisted. However, last year, during the big run in gold, it hit an all-time high of $6.75. So had you invested $10,000 in 2013, that would be $611,000 today, or by the time it delisted, or $843,000 at its peak. And obviously, I've had some experience with Chalice that went from 17 cents to over $4.30, sitting around $4.50 at the moment. Northern Star, which Saracen merged with. Northern Star in July 2010 was trading at 5 cents. Today, it's trading at $9.90 with an all-time high of $17.03 last year. So a $10,000 investment 10 years ago would be $1.98 million, say $2 million today, or $3.4 million at its peak. So this is the power of, these explorers. When you do find these explorers, they really give a punch to your portfolio. And as you can see, $10,000 investment. So if you've got $200,000, $300,000, $400,000, as your investment portfolio, putting $5,000 or $10,000 in some explorers, I don't think is too much. I'll put a link in the description to this video from Shae Russell, Guide to Picking ASX Gold Stocks, Tips and Tricks. So it's a really, really good video. Shae, for those who don't know her, she's very well known in the gold and silver, both mining and exploration space in Australia. And you'll really, really enjoy this video and pick up a few tips from her about what to look for in the gold and silver mining and exploration space. Some of the things to look for in a gold explorer or miner is a company that has a resource base that will support their market cap. Also assess the level of hedging in the case of gold producers. So, that they've locked in, some of their price, so they've got that assured income if the gold price does fall, but not locking it all in case there's a price or a rally in the gold price, and they miss out on that. So you want a little bit of hedging there for the producers. Exploration companies that are surrounded by majors and a producing mine can provide a windfall if a discovery in the region is made. And I've certainly got a stock that has now, from when I bought it, has gone up fourfold, and it is right next to a big producing mine. Those that have sufficient cash reserves available and the ability to mobilize drilling rigs in the event of a gold price rally will stand to benefit from reporting exploration results when speculators are looking for the next major discovery. So having a quality balance sheet, having plenty of cash reserves to really get going, because when there is, like last year, when the price of gold and silver really started to run up, and we saw some explorers really get drilling and announce some drilling stuff, and all of a sudden we saw the price of many of these explorers really take off. The other thing that's also important to note is the management. So I look at who the management are in the team, how they're spending the cash reserves, especially in the explorer space. How are they spending their cash reserves? Is there a lot of admin type costs involved? You can generally get access to that sort of information, but also just their track record. What other miners or explorers or success have they had in that space before? So looking at management is very important. Now, Kalgoorlie has a rich tradition in gold mining and exploration, and no doubt during the next upswing, the rumours and discussions in the local bars will reach fever point. Also, watch out for stories on companies on different internet forums So just make sure that you've got a working knowledge of which juniors are carrying out exploration or have further work planned. Don't rely on stock tips or things you read on internet forums. Okay. Also, due to rising exploration expenditure as a result of renewed interest in the gold sector, investors are more likely to be faced with a daunting task of trying to decipher company reports in terms of the exploration success and failure. Whilst a high-grade hit may cause a speculative frenzy, it may be at a shallow depth and may not be an accurate reflection of the potential resource. In other cases, a relatively low-grade result might be at an excellent depth and indicate that a low-cost mine could move into production. Yeah, and so when you're looking at the exploration results, the higher the grade at the depth, the more excited investors become. But when you've got, say 1 meter hits at 230 grams per ton, it may seem attractive in comparison to other results. It's often the shallow nature that may result in some apprehension over the continuity of the resource. So where solid results at depth such as 15 meters at 8 grams per ton that flow throughout a report will indicate there is a greater likelihood of a continuous resource with impressive grades that may ultimately have an impact on production costs and stuff. So it's looking at not just the high grade at a shallow nature, but looking at really good solid grades per ton at depth. That is a key, I think, anyway, moving forward. Yeah. So there are 3 main types of drilling. You've got your RAB, your rotary air blasts. This is often the cheapest form of drilling, but also the least accurate. It operates in a similar fashion to a hammer drill, where drill cuttings are collected as they reach the surface. Not too many explorers that I know use this now. Reverse circulation is another one. The drill cuttings are effectively forced into the hollow drill bit, which is achieved through compressed air or fluid. It's more expensive than the RAB, but it's also more accurate than the RAB. Most of the explorers that I are invested in actually use the diamond core drilling. So diamond drill bit rotates to cut a sample of the rock rather than grind it. The solid core of the rock collected through the drill bit. It is the most expensive form of drilling, but also the most accurate. So yeah, and then there's some other things like resource definition, whether it's inferred resources. So a company might say we've got X amount of resources, but it's inferred. That just means that the data is insufficient to confirm the resources continuity. Indicated resources also contain insufficient data. However, they can give what is considered a more reasonable indication of the resource there. Then you've got measured resources. It contains sufficient data that's able to confirm what type of resource they have there. And then you've got probable and also proven. The other things as well to think about is whether the resource needs to be an open cut or underground. So obviously there's going to be different cost structures involved with that. So open cut is obviously more, underground is more expensive than an open cut. And then also mine infrastructure. So is the discovery out in the middle of nowhere where there's no water? So then the company will need to develop roads, water, power supplies, even living quarters and stuff like that. Maybe an airstrip or something nearby. So there's those sorts of things to look at as well. So yeah, hopefully that gives you a bit of an understanding of what to look for in a gold miner and a gold explorer. Definitely check out Shae Russell's video. I'll put a link in the description below. very well worth your 20-25 minutes watching that as well. Today's video we spent talking about gold and silver miners and explorers and the leverage that you get on the underlying asset there. What I want to share in the next video is really my bread and butter. This is where I make most of my investment income, is trading covered calls, selling or writing covered calls. I've been doing it for over 13 years now. You can see here back in 2014, you can see some of the premiums for the month were 6%. Now my average premium each month is about 2%. So yeah, you can see this portfolio, current share, 42,000, earning over $2,000 a month. However, as I said, usually, and I usually do 1 month contracts, sometimes 2 months, but mainly 1 month contracts. And I'm usually getting about 2%. So if you've got a $100,000 portfolio getting 2%, that's $2,000 a month. If you've got $300,000 portfolio and you're getting 2% a month in income, that's $6,000 a month. Now, this is one of the most easiest trading strategies I think that are out there. One of the most simplified, simple trading strategies that anybody can learn. And people I've chatted to, people I've kind of introduced this to, have gone away and learned it. You know, they are not sophisticated investors whatsoever. And I've got a lot of friends now that are trading covered calls in their self-managed super fund and outside their fund, generating either income to live off, or for those who are younger in their self-managed super fund, earning this income, these monthly premiums, reinvesting it back into more stock, writing a new covered call, getting even more premium, and using that compound growth to grow their portfolio. And it's probably been the biggest factor in growing my portfolio over the last 13 years is really having that compounding growth. So, you know, I'm kind of averaging 2% a month on this. That's 24% over a year, plus some dividends and whatnot. In fact, I think I do average closer to 30% using this strategy. So, and that's not taking into account any capital gain in the actual stock price. So, yeah, I'm gonna in the next video talk a little bit more about this cover call trading strategy. For those that want some material on that, I'll provide that in the next video, where you can get access to more material, where you can learn about it and start trading it in small ways, learn how it works. There's a great options course on the ASX website. It's a free course, and I'll speak more about that in the next video. So anyway, guys, hopefully you enjoyed this video. If you liked it, please hit the like button. It really helps the algorithms. If you haven't yet subscribed, hit the notification bell so you get all my videos when I release them. And also, love to see your thoughts and opinions in the comments below. It's been a lot of fun to interact with you guys, and you know, really appreciate it. So until then, I'll see you again on another episode of Finance Uncut.